Welcome,
Yeah.
everybody. If you've
Oh,
joined us, we are about 5 minutes away from starting, but looking forward to hearing from Bill Bodnar today. If you want, put where you're joining us from in chat. Would love to see, where you're from, what company, what area. Good morning. If you've joined us, we're going to wait about 3 to 5 minutes for others to join before we start. Looking forward to having you on our webinar. Good morning, everybody who's joined. Welcome to our webinar. We're going to wait about 2, 3 minutes and then get started. Well, welcome everybody to our second quarterly MBAC education webinar series. We are super excited to be bringing this to you again. Um, and we're really excited and thankful to Susan Galloway from MQMR for being our sponsor. If you don't know, we do have sponsors for these quarterly webinars, and if you're interested at all in that, please reach out to me. I'm Lisa Green. I'm the MBAC chair, education chair. So Susan, tell us a little bit about MQMR.
Good morning, everyone, and thank you for being in this webinar. And I know I'm the only one standing between you and Bill Bodnar, who is our amazing speaker today. So I will go really quickly, but it was our pleasure to be able to sponsor this webinar. For those of you who do not know MQMR, it stands for Mortgage Quality and Management Research. I'm Susan Galloway, and I lead as the National Account Executive covering the Southern U.S. So what MQMR is structured to do is we study quality trends, operational performance, and risk within mortgage processes. So our reports combine data analysis, quality findings, and research-driven insights to give us a clear picture to see where our clients stand in their risk management. Traditional reviews focus on defects. MQMR actually goes deeper, and we connect data points across servicing, compliance, and operations to identify patterns and emerging risk. So we don't just focus on the defects, but we focus on what the emerging risk may be and how you can correct them. The real value is we turn information into insight. So we can help you, number one, strengthen your risk management compliance. We can anticipate, number two, issues instead of having you react to them. And we also support better decision making by giving leadership a complete and accurate view of performance. We know many of you have amazing risk management and compliance departments. We are not here to replace them. However, we work alongside them to assist them and to help with state exams and any other issues that may come up. So just a quick overview of what we offer, and this is only a sampling. We have internal audits with about 14 areas of interest. We have HMDA audits, fair lending audits, AML audits, which we all need to do. This audit is required. Everyone has to do an AML audit, and it has to be done by a third party. We offer monthly compliance and servicing compliance. This is a month-to-month service, and it's unlimited time with our attorneys on operation questions. Anywhere we provide policies and procedures to let us look at your marketing information, see if it's compliant, all the way down to a closing CD to see if there's something wrong with that. And the same thing on the servicing side. We also can offer vendor management, which has been a really big growth in our company over the last year. And for those who do servicing, we can offer servicing QC. So with MQMR, you would be in great hands, and I'm going to turn it over. Thank you for this time, and I'm going to turn it back to Lisa.
Thank you, Susan. And if you do want any additional information, please reach out to Susan Galloway. As we're going through our presentation today, put any questions you have in the Q&A, keep them to the end. We will leave some time to get those questions answered if Bill doesn't already answer them in his presentation. We are super excited to welcome Bill Bodnar back to our webinar series. Bill joined us last year, and it was incredible value. Also, something that the MBAC Education Committee is doing is a quarterly newsletter. And Bill does a quarterly sort of spotlight for us about the markets. Thank you, Bill, for that. If you're interested in subscribing, you can reach out to me, Lisa Green, and we'll get you signed up. So without further ado, I'm going to introduce Bill for those of you who don't know him. So, Bill Bodnar is the Chief Revenue Officer at Tabrasa, the AI powered mortgage growth platform that equips thousands of lenders and loan officers nationwide with integrated tools for marketing, CRM, video content, actionable insights, and more, all designed to help mortgage professionals work smarter and grow their business. He is also the driving force behind MMG Mortgage Market Guide, the industry's premier source of mortgage and economic intelligence for over 2 decades. For more than 25 years, Bill has delivered clear, practical market insights that empower thousands of mortgage professionals and real estate agents to succeed in any environment. Blending deep expertise with a fun, engaging style, he remains a highly sought after speaker and trusted voice across the mortgage and housing industry. Welcome, Bill, to Reading the Markets.
Well, Lisa, thank you very much for having me. And Susan, thanks for being part of this. So there's a lot to talk about. I mean, and it's great to do that little clip in your newsletter. Thank you for promoting that. You do a really great job with that. So yeah, reading the market. So what are we going to do? Let's spend the next 45 minutes or so talking about where we are in real time. And as we go through this little talk together, Lisa mentioned, the realtors are some folks we help. And I think when I look at this, I do a lot of traveling around the country, and you can see what's really been amazing is everybody's doing business. Deals are getting done. The economy's actually performing pretty darn well despite a lot of uncertainty. So I'm going to kind of walk through some of the big themes that are happening right now. And let's leave some room for questions and have some fun. So hopefully you'll take a couple of nuggets with you as we leave in a short while. But let's get right into it. So anybody know what the creature from Jekyll Island is? This is where it would be good if we were live and we had hands showing. Maybe I'll have to figure that out. But the creature from Jekyll Island is the Federal Reserve. There's a book out there with that name. And, if you know off the coast of Georgia there, you have those 6 individuals. And you had a senator and 5 really high-powered folks. Think of like today would be like Elon Musk, Jeff Bezos, and Zuckerberg going to this island resort and using their first names and make believe they're duck hunting. And they hid in this room for a bunch of time and laid out the framework for what would be the Federal Reserve. And hence the name, because it has since been a creature. So let's talk about the Fed, because it's one of the elephants in the room right now. Now, at the last meeting, not this one that just passed, but the previous one, he did what my teenagers would say. He did us a solid. He used the term underneath his picture there. Fed Powell says long-term inflation expectations are well anchored. And it was that moment that actually turned the bond market around recently and allowed rates to improve. Well, what did he mean by that? So there's a lot of noise. Part of the reason why you have to pay attention to this stuff and have what we call a market position at Mortgage Market Guide is that the media is not your friend on this, right? Remember, the media doesn't say, hey, Lisa, thanks for tuning in. Things are great. See you next week. It's all about doom and gloom and all this stuff. And if you allow your clients and your partners and your builders to extract the news from the news, boy, it's really tough. You put yourself in a tough spot. So you got to be able to understand some of this. And so what is he saying there? He is essentially saying that you and I do not think that inflation is going to be a problem long term, that our expectations for inflation are well anchored. They're not going to get crazy high. And that's a little bit different sometimes from what you hear in the media, because, I remember watching my television set last year and I was told we were going to have stagflation. U.S. exceptionalism was gone. No one's buying the dollar. No one's buying our debt. There was going to be a recession. I could probably ramble off about 6 or 7 more negative things, none of which have ever happened. And so when I hear things like the Fed chair, who did a nice job of kind of calming the market down, that's a good story. And so when part of what I would share with you as you go through, the news, and even whether you agree or disagree with what I say here, one of the things that you should take away is look at what the bond market thinks. I look at the 10-year note as one of the more smarter folks on the planet, and it's forward looking, right? And we're going to talk about the conflict and all that. So look at the bond market, because if inflation were going to be a real bugaboo long term, the 10-year note wouldn't be hovering near 430 would be much higher. So, but that's a little bit on Mr. Powell at that last meeting. Now, at the recent meeting, things were a little different. You may recall he pulled a little bit of Wolf of Wall Street. Remember, I ain't ever leaving. Well, he didn't say that, but he did say, I have no intention of leaving the board until the investigation is well and truly over with transparency and finality. So if you've been following along, he's gone as Fed chair, but his term as a governor doesn't end until 28. Now, it is very, very unusual for a Fed chair to leave and not leave, but to stay on. In fact, it's only happened one other time in the 113-year history of the Fed. And at that moment, that was when the president wrote a letter and pretty much begged that Fed chair to stay. I am quite sure that Mr. Trump is not sending Powell a basket of flowers and say, hey, please stay with us. But to move beyond him, because we are moving beyond Mr. Powell, the markets are taking it in stride. I think in that last meeting, when he said, Powell, that I am not going to be a co-Fed chair, I'm going to kind of just go sit in the background, I think the markets took that as like, okay, maybe he's going to play it right, but it's really not right. And, I think I'll stay out of the politics of it. Some people say, he's a martyr, this and that. Forget about all that noise. He is going to move on, and Mr. Warsh is going to be our Fed chair. And I want to talk a little bit more about that and where we're headed. Now, part of Warsh's challenge going forward is there's a lot of division within the Fed. I mean, everybody wants to talk about, the politics between maybe the president and Powell, but there's a lot of problems within the Fed's own body. This is the dot plot. And the dot plot is where 19 Fed officials kind of cast their vote of where they see rates. Well, I can tell you right now that Susan and I have an equal chance of telling you where rates are going to be next year. Because if you look at the dot plot in 2027, it's a pretty big dartboard. It's anywhere from 2.5% to 4% on the Fed funds rate, right? It's all over the place. There is no unity. And you can imagine as these Fed officials are talking and telling us, we're going to go higher for longer. Oh, maybe we should cut. The jobs market is strong. Maybe it's weak. There's no inflation. There is inflation. It's madness. So now we have 19 quote unquote independent thinkers, and they can't really get their arms around. It's the most divided Fed we've seen in a long time. So Mr. Warsh is not actually inheriting a body that's kind of running on all cylinders. Remember that they've missed it on their mandate on inflation for 5+ years running. Mr. Powell may not like to hear this, but the problem that we have with affordability, which is mainly driven by housing prices going up 60% in the 5-year span between 2019 and 2024, that lies at his feet for buying mortgage-backed securities too long. So, there's a lot, the legacy of the Fed, Mr. Powell's Fed, was not very good. And so there's a lot of cleanup to do. And, but this is the dot plot. Now, a couple things. This gal on the left, you may recall, right? She lived in a material world where the guy on the right, that's New York Fed Williams, he says we live in a low neutral rate world. And if you do not know what the neutral rate is, the neutral rate, think about it as the Goldilocks rate of the Fed funds rate. The Fed funds rate right now is 3.5%. The neutral rate is a rate that neither helps or hurts the economy. So right now at 3.5%, call it, that is what we would say is mildly restrictive. It's trying to tamp out that last little bit of inflation, maybe slow the economy down without trying to perk up unemployment. So there's no debate amongst the Fed that the next move is going to be a cut. It's just a matter of how much do we cut and where do we get to. So right now, I'm saying pre-Kevin Warsh, there's this idea that we're going to cut once this year and once next year, bringing in the terminal rate. It's also called the terminal rate when we stop cutting or hiking. And that Goldilocks or neutral rate is 3%. Well, Mr. Williams says, hang on a second. We live in a low neutral rate world. We're getting to a spot where we're going to go where the neutral rate was before the pandemic, like somewhere between 0.5% and 1% would be what they call the R star, right? And then when you add 2% inflation, we're maybe something closer to 2.5% to maybe even 2% on the Fed funds rate. So he's saying, hang on, we may not be cutting twice over the next year or so. We may be cutting anywhere from 4 to 6. And so that's a voice that I listen to because he is a powerful member of the Fed. He's always voting. He never rotates. and he handles all the bond market operations at the New York Fed. So when he speaks, it's worth listening to. Now, I'll move on from this Fed funds rate chart and this one, but I do want to talk about Kevin Warsh and spend a little bit of time here because he is going to be the next Fed chair. And so I spent a little bit of time on him to give you folks just a few nuggets to think about. Because again, I don't think the media is going to, it's going to be mixed, right? I watched, sadly, the confirmation hearing, with the politicians. Good grief. I mean, remember, this guy was on the Fed. He was unanimously voted in back in 2008 or something as a young man. I think he was 34 years old, might be the youngest member of the Fed ever. And so he's super, super qualified. But, they called him names, sock puppet, all this dopey stuff. Stay away from the politics. Here's his story. He was on the Fed in 2008. And at that time, it was a really crazy time. For context, we had outright prices declining in homes. We had prices declining in stocks. We had outright deflation for really almost the only time in our history where prices decline. And deflation, folks, is even worse than inflation. Deflation is the housing market that China is going through. China has 1 million homes. They have the lowest interest rates, and nobody wants them. Why? Because they believe that if I wait, I can buy it cheaper. That's a horrible, horrible deflationary spiral. We don't want anything like that. So when we were having deflation back in, at that moment in time, the Fed had this idea that, hey, maybe we should go out and try this idea of quantitative easing, where they go out and they purchase long-term bonds to help drive down long-term interest rates, and that would help fluff up assets, maybe get people to stabilize the housing market, get some activity, and it worked. But like all things, it kind of fizzled. So then they said, later, closer to like 2010 or so, they said, well, maybe we should do like another round of quantitative easing. It worked the first time, we'll do it again. So keep me honest here. There's an interview, you can Google it, called Inflation is a Choice. And in this interview with Kevin Warsh that was recorded last year, he didn't out this member, but he said, well, hang on a second. Are you suggesting that we just allow our government to spend more money, create bonds, and then we turn around and buy those bonds? He said, it sounds like a Ponzi scheme. And that's when Kevin Warsh stood up and said, we can't do this. This is mission creep, right? We have a mission. Our dual mandate of the Fed is pretty darn clear, folks. It's inflation and it's the labor market. That's it. And so he said, we're delving into fiscal policy. This is something the administration, the White House has to solve. We can't just buy bonds, lower rates, and there has to be more than that. And so he quit, right? He had a few more years left in his term and he quit. So with that framework, he quit the Fed because he didn't like quantitative easing. So guess what? Bullet number one, we have, since 2008 until today, we have amassed just under $7 trillion worth of bonds. We've been buying bonds, putting them up on a shelf to help drive down long-term rates. And we've created fits and starts in housing and certainly created the incredible unaffordability problem that we have today as it relates to housing, because we basically jacked up home prices 25% year over year for 2+ years in a row because of the bond buying. And that's what really hurt us. It's not, affordability didn't just wake up this morning and say, here I am. It was the aggregate of prices rising crazy between 2019 and 2025. And we're paying for those ills today. So the first thing he's going to do is shrink the balance sheet. Now, what does that entail? Well, it's the opposite of buying bonds and lowering rates and sparking inflation, right? What it does is it basically keeps long-term rates maybe somewhat elevated. It tightens up the system a little bit, and it definitely stomps out inflation. And it does not fluff up asset prices like the stock market. See, Mr. Warsh is not in this for the stock market. If you look at that bottom bullet, that image, it says, if we were to cut rates, a broader range of people would benefit. He's not talking about Wall Street. So in number two, what does he do when he tightens monetary policy a little bit by maybe shrinking the balance sheet? Well, he does number two. He cuts interest rates for our clients in small business. See, he is interested in getting small business going and creating supply side growth. And when he looks at number five, economic growth is not inflationary, that's going to be an enormous departure from where the Fed has been, because I've been doing this for a long time. I mean, mortgage market, guys, 25 years. I've been watching markets since I'm a kid and always been fascinated with it. And one of the things I never understood over the last 30 years or so is how come, economic growth, what is a hot economy? What does that even mean that I have to keep rates higher for longer because it's hot? Because when I think of a hot economy, I wonder, is it like a hot housing market? Because think about a housing market when it's balanced, when we have a lot of supply and we have nice, low, stable rates. What happens in a market like that is you have balance. You see houses flying off the shelf, but what you don't see is a bunch of melees in the driveway driving up prices because we have a housing shortage. When you have a ton of supply and houses are moving, prices do not go up. In fact, it's almost disinflationary because I have a lot of options. That is essentially what he wants to do with the economy and working in tandem with Mr. Bessent and the administration. This is where monetary policy and fiscal policy have to work together. You may recall, that has to work together because if it doesn't, you can't drive long-term rates lower and spark growth. So this is going to be a fascinating turn of events. And for us, we're selling money. I couldn't be more excited, and you should be too. So it's going to be a good change, and a lot of things are going to happen. It's going to make you have to watch the data. One of the things that's going to happen with Warsh, there's this policy called forward guidance, right? Where Fed officials talk and tell us where they see rates going, so on and so forth, and they try to guide the market. Well, I think it's a bunch of crap because when you have 19 Fed officials, as I showed you, with the dot plot all over the place, what help are they giving us? If Goolsbee thinks we got to go higher for longer, and then Waller says, nah, we could probably cut, and another guy says we have inflation, another guy says we don't. Well, the first thing I need to do is I need to shut off the mic, and that's what's going to happen. So the idea that Fed officials are going to be speaking continuously is over. I don't know. Maybe we may only see Mr. Warsh speak, and he may turn off the mic for everybody else. And let me tell you something, it's going to be great. But what it means for everybody on this call and for your clients is it means you will really super duper have to be dialed in to the market. You're going to have to know where, what economic policy is doing, what reports are now to watch. Because again, one of the things I think is going to happen for sure with the Mr. Warsh is alternate sources of data, trueflation, trimmed PCE from the Dallas Fed. There's a bunch of stuff, private data on the labor market like ADP. So these are going to be very, very different. Even corporate America, layoffs and hiring, those are going to be things that are going to move the market. And that's what I remember as a kid. Like if a company said, hey, we're doing a bunch of hiring, we're expanding, well, that told everybody, crap, the economy's wheeling and dealing, we're going. And so it's going to be a different world, and it's going to go back to a time, maybe longer than some folks in this call have ever even seen. So I'm pretty excited about it, and I think it's going to be it's going to challenge us to be better professionals because we're going to have to look at the economy and the markets in a different way because it's not going to be as easy as, well, Mr. Powell just told me they're going to cut and Goolsbee said this. I think it's going to be a little bit more quiet. Now, on the conflicts and rates side, we learned in this with this kerfuffle with Iran that when you have moments in time where rates are hitting what levels that make sense, you need to capture them because typically when bombs start going off, money around the globe finds its way into the U.S. dollar and the U.S. dollar denominated assets like treasuries. Well, this time around, it didn't find treasuries. It did find the dollar. Again, that's when folks said, no, the dollar's lost its exceptionalism. What a bunch of baloney. The dollar roared when this conflict happened. And then when I look at the bond market, it didn't go into the bond market. Why? Because of oil. And I think I certainly know I spoke about oil and 30-year mortgage rates last time we were together. And I've been speaking about it pretty much in every speech for the last 15 years. Oil and 30-year mortgage rates ebb and flow together. And, when we talked about it, it used to be a nice little secret. Like I would do this presentation for, realtors or builders, and you see like the light bulbs go off. Well, fortunately or unfortunately, however you're looking at it, my mom now understands that 30-year mortgages and oil ebb and flow together because it's the driver of what have been rates for the last, 8 weeks or so. What has oil been doing? And so this chart, which goes out longer term, you can see here in 2024, oil and 30-year mortgage rates hit 24 lows together. In 25, January 15th or so, oil goes above 81. 30-year mortgages go over 7%. And look at how cleanly they move in lockstep together, lower. This is what we do at Mortgage Market Guide, by the way, to help loan officers kind of promote that they have, a little bit of a pulse or a finger on the pulse of what's going on. And then check out this chart. This is like the modern day misery index, right? That's 30-year mortgage rates and oil. Look at how from left to right, going lower over time. And then right there at the beginning of March, boom, they blast off and go higher. Now, this doesn't capture the decline because that has already happened as well. Has been a little bit of a relief. Now, where are we today as it relates to this conflict? So oil is around $93 as I'm looking or so on the television set. I would say about 1/3 of the price of oil, is attributed to risk premium, meaning this just sits there at $94 and $33 of that or so are sitting there just as risk. Like we're not moving because we don't know what the hell's going to happen next. Is uncertainty, and it just sits there. So the market has improved already off the worst levels. And a couple of reminders, the markets are forward looking. They don't wait for certainty. It anticipates it. And so even today, as we sit here, the markets are starting to sense that we are now probably closer to the end. That's not me talking. That's the markets. When you see the Dow at 50,000, when you see, oil backing off from 120 down to 92, it says at the very least that this is not going to last much, much longer. But we're going to find out. I don't know. I'm not a national security expert, but the markets are telling us this. So we got to watch that very, very carefully. And, I think if this conflict gets resolved quick and the strait gets open, it'll take a couple of weeks for the strait to get back online fully. But the market won't even wait for that. I think you could see oil drop in a couple of pretty good chunks, maybe another $10 to $12 pretty darn fast. And then everything starts to feel better and different. Now, what's amazing about all that is that we're seeing us do business like crazy despite the uncertainty and despite the uptick in oil. Can you imagine when those two things get behind us? Wow, super reason to be optimistic. So I'm going to move past this inflation chart, and I want to talk a little bit about things that are going around the globe. Remember the old Vapor song, Turning Japanese? You do have to look at what things are doing around the globe. And right now, there are big bond markets, Japan, Germany, UK. Those are ones that we watch. And so when you see the Japanese 30-year bond at 364, you'd be like, well, that sounds pretty good because our 10-year note is 434, right? So it's like, well, that sounds good, but that's the highest ever. The Japanese 30-year paper has never been higher than that level. And so as those yields go higher around the globe, it puts upward pressure. It's like, there's a global search for yield. And so it's a challenge, and it puts pressure on our rates just by pressure going around the globe. Now I look over to Germany. In America here, we told these other countries, hey, you have to start chipping in for your defense, right? You got to start defending yourself. We can't be the police for everybody in the world. And so Germany said, you know what? You're right. We're going to build our own military, and they're going to spend some crazy amount, their own version of a big, beautiful bill, so to speak. And it's an enormous bill. Well, their yields are spiking too because the bond market doesn't like more debt. And if you were to ask me, like, what's the one thing to watch for us as a country that could prevent rates from getting much better, it's our debt and deficits. I think they just announced this morning that, fiscal year 26, we're going to have a $2 trillion deficit. That's not sustainable. That's not sustainable because when you look what happened after the Great Recession in the periphery of Europe, call it like Portugal, Greece, they put together these proposals and the bond market pretty much like gave them the proverbial middle finger, said, no, you can't do this. And you're not going to do it. And rates went from like 5 to 12, 13, 15%. They got priced out. So they couldn't borrow from the bond market anymore, and they all had to get bailouts. So I'm not saying that's going to happen here, but part of the reason why our rates are higher is because of this risk premium as it relates to our debt. So getting our debt and deficits in order is something that has to happen, and we have to, chisel away at it. Can't make it go away. It's like an elephant. How do you eat it? One bite at a time. It's not going to evaporate overnight. $39 trillion in debt, but we have to start getting our deficits completely in order, and right now they're not. Bank of America. This is a nice little spot. You can sign up for this. It's free. Bank of America Institute. They can email you once a month, and it tells you the strength of the consumer. Obviously, Bank of America has access to incredible, vast amounts of credit card data. And they're telling us back in February, consumers still hanging around, and that continues today. So check in with that. Real retail sales. This is an interesting chart. Real retail sales tells us the strength of the consumer. You hear retail sales come out, and what you don't hear is real retail sales. Well, what the heck is that? Real retail sales is matters much more. It tells us what people are really buying, because what you do is you take retail sales and you bump it up against CPI, and then you see what people are really purchasing. And so when it flatlines, it means we're not buying more, we're just paying more, and that ultimately leads to a recession. You can see here, we're buying. We flatline, which means we're not buying more goods, we're just paying more, and then we get a recession. We're buying. We flatline for a couple of years, recession. I show you those long flat spots because we have a long one here. We're at the highest point was 4 years ago in April, right? But if you look at the right chart, check out the right chart. While everybody's talking about how bad things are, look at how real retail sales over the last 2 years has gradually crept higher. Now, this means inflation's coming down and consumers are buying more, and we're within a whisker of creating a new all-time high in real retail sales, which would negate any kind of recessionary signal. It's bottom line here, folks. There's like almost no chance of a recession right now. I know energy's high. There's a faction of our populace that are miserable, but there's no chance of a recession. In fact, there's a lot of resiliency that we're seeing, and even some of the economic numbers, the labor market prints. But this is real retail sales. Oops, go back here. Housing. Oh, this is interesting. So Lawrence Yun put this out not too long ago, and the takeaway I want to share with you is what I share on the oil. The slight gain in pending contracts appears to be driven by improved affordability conditions. However, those conditions could reverse if higher oil prices lead to an uptick in mortgage rates. Isn't that interesting? Lawrence Yun, NAR's chief economist. So even he, who I credit him as being a really sharp guy, and he speaks in very simple terms, talking about oil and 30-year mortgage rates, and he's absolutely right. So let's hope that this kerfuffle gets to the end, and I think we're getting there. Now, I'm going to keep this chart up on the board, and I know where you folks are located, and you should be pretty darn excited. This shows you where people are leaving and where they're going. If you're big and blue, your people are moving to you in droves. If you're dark and red, people are leaving. So where I am up in New Jersey, it is not a surprise to see people fleeing because of not only are we tropical creatures and like warm weather, but we also like to be taxed less. We sometimes like a little less crime when we go to a city. And so you're seeing people migrate from northern states and high tax states down to southern states where it's warmer and their dollars are treated a little bit more kindly. And you could see it's everywhere. South Carolina, you can see there's on fire. Look at North Carolina, Tennessee. I mean, this patch is like the hottest portion of the country. And so it's a pretty interesting chart. And guess what, folks? It's probably going to continue. Right? Money moves, people are mobile, they'll pick up and they'll go, and you go where the jobs are, right? Also, you want a business-friendly climate, so you folks are killing it down there and are likely going to continue killing it. You're going to attract people, you're going to attract the jobs, and it's going to be a great thing for housing going forward. So you should be very excited about your position in the overall, in the global, or in the country's housing market. Now, when we talk about action, you can hear consumer sentiment. I urge you not to look at consumer sentiment and consumer confidence, or at least don't make big business decisions on them, because those reports, soft data, they're polls. Polls are surveys. They can be overly optimistic, they can be overly negative, and they can change very quickly. The three things that we watch at Mortgage Market Guide are, number one, rates. Every time we get a downtick in rates, we see the activity. It just shows how ultra sensitive to rates our space is. But then number two, and many of you have access to this, actual loan app growth. If you look at the MBA purchase applications, if those are rising week over week, folks, the train is in motion. And then lastly, pending home sales. If those are turning positive month over month, by the way, we had a nice new home sales print this week, well above expectations, despite uncertainty in the economy, uncertainty with Iran. Those are numbers I'm watching. So when my television set tells me things are dire, I look at this. Is this happening? Because if this is happening, I don't have to listen to anybody else. I know people are in motion. And don't listen to like a poll type of thing or survey, because those could be backward looking and overly slanted in a way that may not be able to help you. I'm going to move past this affordability, but I will tell you the 40-year-old virgin being a 40-year-old first-time homebuyer is not an attractive data point. I think it's now contracted by a couple of years. I think the big thing that I look at going into this year is 2026 is going to be the first year in 15 years. Think about that. 15 years is the last time that wages are going to rise above the rate of home prices. So housing inflation or housing price gains are going to rise nationally 1 to 2%, and wages are probably going to be north of 3. Now, is it going to make affordability disappear? No. Is it a magic bullet? No. But does it help? Yes. And it leads right to what Lawrence Yun said before about improved affordability. It's improved. Is it magical? No way. There's a lot of wood we have to chop. But what we should not expect on a going forward basis is seeing housing prices rising by double digit, 20, 25% certainly, and that's over. That ship sailed. I don't think we see anything like that again. And so we should look for single digit growth. But other things we can do: regulation reform. We have to build homes. Nothing cures our housing problem like more stock. And I think what I see. And I was down in D.C. speaking at a Potomac Curing event, and they had the national advocacy event, and a bunch of CMB folks did a panel. And what they said just a couple of weeks ago, they said what's really refreshing is here we are 15, 16 months into a term of a new administration, and they are still talking about housing. Whereas typically, presidents come and go, things come and go. They take a problem, they'll talk about it for a month or two, and then it disappears. They're still talking about it because, at the end of the day, it is a massive economic, societal, and political issue. And, there's reason that we should be optimistic that we see some resolution. Now, long-term rates, our rates really come more from this gentleman's side of the house, Scott Bessent, in the Treasury Department, and fiscal policy, right? If they do things to manage our debt and outperform the globe, we get rewarded. The opposite is true. And so that's not me saying it. It's the bond market saying it. On the left side is the 10-year note. It is likely, I think it's really the only 10-year paper on the planet lower in yield year over year, right? If you look at the right side, you can see Japan, another big bond market. That's the highest 10-year note since the 90s. Got to go back to 98, folks. That's crazy, right? Lower right, the German Bund. That's the highest 10-year note in 16 years, and still rising. And they're putting out their big war chest kind of money. So it's just, we are the cleanest shirt in the dirty laundry, but we need to do more. I mean, this is probably, I would say, the biggest threat to us in the mortgage business is just long-term debt. How do we get that under? We got to grow. We got to pay it back. We got to pay it down. We got to make the market feel good that we're not going to spend like recklessly forever and ever and ever. And, sadly, it doesn't make a difference where you sit in government. I mean, I've just never seen government go and just try to do more with less. Like you and I, we've all had to figure out, we had to Doge, quote unquote, our business. Unfortunately, we lost a lot of folks during the horrible conditions in the housing market. Maybe even personally, some of us had to make some belt tightening. And it feels only appropriate that, as a government, we try to, because it is a big driver of long-term rates is how we manage that debt. And so we're going to have to watch this carefully going forward, how that performs. I'm going to move past Mr. Buffett because he comes back again. But at the end of the day, when he plunked $1 billion into Lennar and D.R. Horton, I knew that we're going to start building a lot of new homes. And he even said it here, the CEO of Lennar. He said, do I think something will come out of 26? I'd be surprised if something isn't done. I mean, so not every idea is great. Lisa, you can keep the 50-year mortgage, right? But some of the other things, they're all directionally correct. Are they all silver bullets? No. But, lowering regulation, maybe buying bonds to narrow the spread, maybe stopping, Wall Street from glomming up houses in hot areas. I think they're all good things. I mean, all these things add to making housing better, and it's a good thing. Productivity is something we're starting to watch here at Mortgage Market Guide. And even this morning, we had a good productivity print. Obviously, we're going to see AI do a lot of this. And when you think about productivity, what is it? You hear about it. It's doing more with less. Well, it's how do you get there? Productivity growth is created by how much output growth minus the hours worked. So if you have high productivity, that keeps inflation down because it doesn't cost you more. It gives the Fed room to cut rates. And this is why it's important for you to understand this, because this is what Walsh is talking about. He's talking about increased productivity. And this supports economic growth without overheating. Remember, I said, Walsh is like looking at an era where, we want to let this economy run. We want to let this economy grow. It's something much more than it ever has, and there's no reason to hike rates and stifle economic growth. But when you have low productivity, that brings in risk of inflation. That creates higher for longer rates, and it slows down housing demand. So we watch productivity, and when we look at productivity, these are like the three buckets. You can work smarter, you can be more efficient, or the boom. We're going to all look for the boom, but the way it works, and when you look at these numbers, the work smarter is that green bar. We've increased our output by 5%. The red bar is 0. We haven't worked an extra hour, so we had a 5% bump in productivity. That's pretty darn good. If you could just get the same amount of output without working an extra minute, that's pretty cool. Now, on the efficient side, how about we don't increase any more output, but I've trimmed my hours by 5%. That also gives me a 5% bump. That's not bad. But the one that we want to strive for as individuals and as a company is that boom. We want to elevate productivity maybe by 10%, but then work a little bit more. It's not hard work. And I try to teach my kids, work hard. That's something that we lost during this pandemic, that idea of hustle, right? Get out there and hustle, outwork your peers, and then get that 8% bump in productivity. That lowers cost. I mean, it's just fantastic. And that's kind of where we're headed. So I'm excited about the economy becoming more productive and getting out of that malaise of sitting around. I mean, it was amazing. That work from home, it seems like 100 years ago, but it wasn't that long ago, that whole work from home thing. And, I think it bred some laziness that we're just kind of working out of right now. Thankfully, where I am close to New York City, see a lot of people going back in New York City and working, which is fantastic. And people starting to hustle. And I think we're going to see a nice uptick in productivity, which is going to benefit our economy. Now, you may remember this old banger tune, right? Bust a Move. So Young MC was not talking about the MOVE index, but I will. So the MOVE index measures the volatility in the bond market. And it's available. You can track it. You can pull it up like probably free, like on Google or something. Just like a look. What's the MOVE index? I see probably a chart. So the MOVE index measures volatility in the bond market. So as it's going up, volatility is increasing. That hurts us in two ways. Number one, it elevates long-term rates. And number two, it widens the spread between 30-year mortgages and the 10-year note. So we get that double whammy, which we just recently felt. Now, the opposite is true. We're seeing the MOVE index decline. That volatility is coming out of the market. Why? Because the conflict feels like, maybe it's a little calmer. Maybe we're getting towards the end. That's certainly what the markets are telling us. Oil's coming down, so maybe rates can come lower. So not only do rates get lower, but then that spread narrows between 30-year mortgages and a 10-year note. And so, right on cue, this was last year. We had a 3-year low on the mortgage spread, but it is narrowed to about 200 basis points. The long time spread is about 170. So that means with the 10-year note at 430, we could see mortgages get back to 6% without the 10-year note improving at all. Right now, it's called 630, right? 200 basis points. So 10-year note's 430, at 200 basis points spread, you're at 630. So this idea of the spread continuing to narrow to more historical levels, if it got to 170, 430 on a 10-year note yields you a 6% mortgage. Now, obviously, you could do the math and imagine what happens if the 10-year note later this year dips below 4%, which is not out of the realm of possibility, right? What if it's 375 and you add 170 basis points? Did you have a 5.4 handle, a 5.5 30-year mortgage on your dance card? I know the NBA did. I was just at an event in Wyoming and Mike Frantantoni spoke in front of me. I respect him dearly, but he pretty much said, I'll just say it. It was kind of like a lazy forecast. Don't expect rates to do anything for 2 years. I was like, what? How could you say that? We're going to get a new Fed chair. We're going to have a new outlook. We're going to have a different economy, right? We have disinflationary forces that are out there. Why would you say that? I don't know what rates are going to do, but just to say Rates are going to do nothing for 2 years? Good grief. I will push back on that one. We'll see. So speaking of which, let's talk about rates. Let's get into where we are now and give you a couple nuggets that you could take away. So this is my mortgage market guide platform. As prices go higher, rates go lower, and the opposite is true. This is the recent sell-off. Now we use Japanese candlesticks, and this is our methodology, by the way. At Mortgage Market Guide, what we do is we talk about all the things we talked about: Fed, inflation, labor market, GDP, things around the globe, oil, all that stuff. And then you have to look at the charts, right? If Lisa told me, Bill, go buy this stock, it's great, the last thing I would do is go buy this stock without looking at the charts. Well, if I weren't going to buy a stock, a $10 stock, and put $100 into it, why the heck would I lock a loan without looking at what the charts are doing? Can you imagine? And so what you're going to see over the next couple moments is there are absolutely better times to lock and better times to float. When you combine this with the data and the news and the fundamentals, you could really, you can outwit your competition and get people to take loan applications with you. You know, I spoke with a group yesterday in Wyoming. It was a big producer at Guild, and she said, Bill, I never use Mortgage Market Guide. And I did a little call like this with her yesterday, and we had just a candid talk. And she said, Bill, I literally got a deal from a bank that I wasn't getting simply from our 20-minute discussion that we're having like this today. So if you don't think it works, it does. And so let me tell you where we are today. So we're looking for a reversal, right? You can imagine as a mortgage professional, when you have a sell-off, you need a trend. So the trend is lower in price, higher in yield. And so we're looking for a signal, an early turning signal that things may be changing. And we got it at the end of March. On March 26th, this red candle on Thursday, we made a new low. Then the next morning, we opened way the heck down here, below par. We're like, oh no, this is terrible. But then we closed and got even on the day. Can you imagine if you bought a stock and you buy it at $20, the next day it goes to 10, opens at $10, you're down $10, and then it rallies all the way back and closes the day at 20. I don't know about you, but I'm feeling pretty darn good, right? I'm even. But more importantly, it negated all of that negative energy that had existed throughout the day. And so what happens? Well, right on cue, the buying pressure the next morning was so immense in the bond market that they gapped prices way above the previous day. And we go higher still. So there are people on this call and or your loan officers that locked on this day. They were looking for witness protection because if their clients had an internet or any ability to see what the heck happened, that loan officer is in hiding because rates did nothing but improve and they didn't look back. We may look back and this might be the worst time to lock a mortgage rate all year, maybe the high tick. And so, yes, there are better times to lock and float, but it continues. So everything good happens above the 200-day moving average, right? I've made that my own term because in the stock market, they say nothing good happens beneath it. Well, right now, as we sit here, the 10-year, the mortgage-backed securities are trading beneath its 200-day moving average. If you don't know that, and you're just telling clients, call me in a couple of weeks, things look great, you're not guiding them appropriately, at least not by the charts, right? There's no reason to suggest that because, again, nothing good happens beneath the 200-day moving average. And I'll show you what that looks like. Another thing that I want to share with you, you know, we're close to 101 right now. 102 on the 5.5% coupon for the last 3.5 years has been a ceiling. So that means because about 400 basis points in mortgage pricing equates about a quarter in rate. So right now we are within 0.25% of the best rates in 3.5 years. So that means if you have loans that are closing soon, you know, you're out there a couple of weeks, and you have the 200-day moving average above you, I would say, Lisa, my dear, please, we need to lock this thing now. We are within the best rates of 3.5 years. Could it get a little bit better? Yes, but this thing could get away from us because we've never gotten above it. And I have to ask you, you can figure this out. How the heck do mortgages get above this ceiling with this Iran conflict still going? It just doesn't. Why would somebody in the bond market buy a bond and stick their neck out with this kerfuffle still existing? It doesn't happen. So you just simply, as we get closer to this line, you have to work feverishly to get more and more people in the boat with you, because we could even get a sell on the rumor. We can get right up to it again, like we did, you know, back at the beginning of the year, and we could sell off maybe when this conflict gets resolved. Who knows? Everybody says rates are going to go lower. What happens if rates, oil drops, but all of a sudden stocks go higher and the bond market takes it on a chin because June rates go up historically? I don't know. It could happen. But these are the things that you got to watch. And you combine it all and you can get somebody to move. There's another one. Here's another ceiling. Resistance becomes support and vice versa. So back in January 26th, this was a price low. So this was a rate peak at the time. Then we stayed above it. We bounced, prices went higher. And you could see here, we tried to stay above this bottom, but we fell. And look what happens when we fall. We fall fast. This was right as the conflict was heating up, right? So we dropped, we go down to the lows of March. Look, we come right back up to this exact same level. And by the way, folks, over the last couple of months, this little level is as good as pricing has ever been. And even though the days were green, rates were better, we were telling our subscribers, you got to lock. You got to lock because we didn't get above this. If you don't get above it, this is as good of a time as any to lock whatever transactions you have. And if you did, you look smart. If you didn't, you had to endure a sell-off. We went all the way back down to here again. So these levels, they work and they're every day. So I'm going to show you where we are. You know what? I'll give you a real-time feel where we are in a moment. But we're below this level right now, right? We're below this 200-day moving average, and we're trying to get above this 50. So right now, these lines are acting as a ceiling, limiting prices from getting higher. So I would be really cautious. If you have loans that are closing soon, I would encourage my mom to lock a loan right now if it's closing relatively soon. Now, if it's further out, you have some things to watch, and I'll show you. I'll move beyond this, and I'll go to my 10-year note. The 10-year note right now is at around 435. It's up here, up in this level. If we go above 435, there's this gravitational pull towards 450, which is obviously bad. If we stay below 435, it now could reintroduce what we call jokingly the Snoop line, 420, right? We can get back down towards that 420 mark. 420 has been clear. We have been above and below it and testing it for years. It's just remarkable. And I think right now, as we're speaking, that 10-year note is around 435, 436. So it can't get beneath that 435 level. So if you have loans closing soon, you use these key levels as a guide to kind of move you forward and let the client make a choice. But if I were to look at where we are this year and going into next, 26 is the year life goes on. It's going to be better than last year. It's going to be, and that's despite the uncertainty around this conflict. Kevin Warsh is going to be a fantastic Fed chair. I am really stoked for him. Young, Bessent, Buffett, follow smart folks. Fiscal policy is just kicking in. We're seeing economic growth start to accelerate in the second quarter. Affordability is going to improve, and household formation exists. The idea that these youngsters don't want to have families in a home is baloney. I have a couple in my house. They don't live with dad. They want to move on. And then I'll leave you with this. If we're not connected on LinkedIn, I just posted it this morning, and I share a lot of content that you can share. There's a saying he uses: be fearful when others are greedy, and greedy when others are fearful. There is a segment of the populace that are out there right now saying, I just heard it last night, I don't want to do anything. I'm worried about a larger scale war with Iran. Now, listen, I'm not going to poo-poo it, but the markets do not see that. And what I worry about for someone that thinks that way is that if you wait for things to be abundantly clear that the problem is not going to get much worse. And by the way, if there was a larger, bigger war, it could be awful. It would be terrible for the globe. But upon the world seeing that that's not going to happen, now the opportunity doesn't exist. Now everybody knows it's not an opportunity if everybody sees it. Right now, you want to be greedy when others are fearful. And so kind of use that theme, whether you're buying stocks or you're buying a home. If you have the opportunity to buy a house, you can get today's rates, which are now within a quarter of the best rates of the last 3.5 years. We have a debt problem. When you talk with all this stuff, you have to lean somebody your way. So I'm going to stop there. I will leave you. We do a great job at Debrasi. We want to know how we can help you. I think, Lisa mentioned at the top, we have a ton of functionality. We can replace all of these kind of usual suspects, the Surefires, Total Experts, HomeBot. We do a lot of cool things here. But if you want to take a baby step with us, I'll leave this up here. It's just a free 2-week trial you can take to our mortgage market guide. So Lisa, I'm going to come up for air. I know I went a little long, but it was great to be
Great
here.
stuff. Thank you, Bill. This is
You bet.
amazing. And I totally would tell people to take advantage of the test drive of Mortgage Market Guide. Our company subscribes to Mortgage Market Guide and Bill's product, and it's great. And with things changing, it's always good to have a consistent, good voice, and you provide that for us, Bill.
Thank
So
you.
thank you very much. I do want to open it up. If there are questions, put them in the Q&A. Um, I did have one question. It's something you had up there, but I know in probably the sake of time,
Mhm.
I had to skip over. Where do you think, if anything, is going to happen with LLPAs? Because as everybody knows on this call,
Yeah.
if we were able to reduce LLPAs, you're reducing the rate for the majority of people. Do you have any
Yeah.
feel for that?
Frankly, I can't believe it didn't happen already. That seemed like low hanging fruit. And, I know that, they talked about it and, some LLPAs came out for different types of properties, and that was a disappointment. I'd like to think something's going to happen, but I'm kind of disappointed that it didn't. Like, what could possibly be the hold up? Hold up. That just seems like an easy one. So I think that that's something like that's going to happen. But I was like, oh, geez, in the spring housing market, I felt like a good opportunity to really give folks a boost. But it just didn't take place. And I scratch my head as to why. It just doesn't
Okay.
make sense to me.
Yeah, no, totally. Definitely feel that same way.
Yeah.
I don't see any questions because I think you actually addressed everything that's going on in the market that's concerning us right now.
Right.
So I wanted to thank you again, Bill. We really appreciate having you as our speaker this second year in a row. I do want to encourage you all to, even if you're not an MBAC member, to get the MBAC newsletter, reach out to me. I can connect you, and then you'll have a quarterly insight from Bill as well. Thank you, MQMR, Susan, for being our sponsor. And
Thank you,
thank you
Susan.
guys for your time today because I know everybody actually it's busy, so which
That-
is great.
That's a great problem.
Yeah. So have a great weekend, everybody, and look forward to our next quarterly webinar.
Take care. Thank you, Lisa. See ya.
Thank you.
Bye bye.
Bye.